Imagine having the power to unlock the true value of any company before making an investment. What if you could see through the noise and hype, getting to the core of a company's financial health? It's not about shortcuts or quick fixes. Success in investing demands thorough analysis and a deep understanding of financial fundamentals. You have to do the work. The key to success in this game lies in mastering the language of business, which is revealed through a meticulous examination of financial statements. These documents, readily available for all publicly traded companies on the SEC site, offer a treasure trove of insights. And the great part is that anyone with the time, dedication, and a commitment to this rigorous practice can gain a competitive edge in the investment world. Again, there is no shortcut to the work. This is where financial statement analysis becomes indispensable for discerning the true worth of your investments. And if you're looking to apply a similar level of dedication to building an additional income stream, starting your own YouTube channel could be a great way to go. With Tube Magic by Matt Parr, you'll learn how to leverage AI tools to efficiently create, grow, and monetize your channel. Matt's course offers step-by-step guidance to help you transform your channel into a profitable venture, whether you're just starting out or looking to enhance your existing content. Ready to take your side hustle to the next level? Click the link in the description to get started with Tube Magic today. To truly understand the financial health of a company, it's essential to grasp the basics of financial statement analysis. Financial statements are the primary tools investors use to evaluate a company's performance and make informed decisions. They include the income statement, balance sheet, and cash flow statement, each offering a unique perspective on a company's financial situation. The income statement provides a detailed overview of revenues, expenses, and profits, with key elements like gross profit margins, operating income, and net income, revealing insights into financial performance. The balance sheet outlines assets, liabilities, and shareholders' equity at a specific point in time, with metrics such as the current ratio, quick ratio, and debt-to-equity ratio helping to assess liquidity, financial stability, and leverage. Finally, the cash flow statement tracks the flow of cash from operating, investing, and financing activities, and analyzing cash flow from operations is crucial for understanding the company's ability to generate cash, fund its activities, and meet its financial obligations. By focusing on these fundamental aspects, investors can make well-informed decisions based on solid data rather than market speculation. The income statement, also known as the profit and loss statement, provides a detailed summary of a company's revenues, expenses, and profits over a specific period, such as a quarter or a year. It is a crucial tool for assessing a company's profitability and operational efficiency. Key metrics to focus on include gross profit, operating income, and net income. Gross profit is calculated by subtracting the cost of goods sold, COGS, from total revenue. This figure reveals how efficiently a company produces and sells its products or services. A higher gross profit margin indicates that the company is effectively managing production costs and pricing strategies. Operating income, or operating profit, is derived from gross profit minus operating expenses such as wages, rent, and utilities. This metric highlights the profitability of the company's core business activities, excluding interest and taxes. Analyzing operating income helps determine how well the company is performing in its primary operations and whether it is able to sustain its business model. Net income, often referred to as the bottom line, is the total profit after all expenses, including interest, taxes, and non-operating items, have been deducted from total revenue. This metric provides a comprehensive view of the company's overall profitability. Consistent net income growth is a positive indicator of financial health and effective cost management. In addition to these metrics, it's important to look at profit margins, such as the operating margin and net profit margin, which are calculated by dividing operating income and net income by total revenue, respectively. These margins provide insight into the company's ability to convert sales into actual profit and help compare profitability across companies and industries. By analyzing these key components of the income statement, investors can gain a deeper understanding of a company's financial performance and its potential for future growth. For example, if a company has a strong gross margin but a less impressive operating margin, it indicates that while the company's core business is solid, there may be a need for cost-cutting measures to improve overall profitability. This insight can guide you in evaluating whether cost reduction is a viable strategy and help you better understand the company's true value. Moreover, examining management's guidance during calls and reports can provide additional context and projections for where the numbers might head in the future. The balance sheet provides a snapshot of a company's financial position at a specific point in time, detailing its assets, liabilities, and shareholders' equity. Key components include assets, which are divided into current assets like cash and accounts receivable, and non-current assets such as property and equipment. Liabilities are similarly split into current liabilities, including short-term debt and accounts payable, and long-term liabilities like bonds payable. Shareholders' equity represents the residual interest in the company's assets after subtracting liabilities, which includes common stock, retained earnings, and additional paid-in capital. When analyzing a balance sheet, it's crucial to assess the company's liquidity by examining current assets against current liabilities, known as the current ratio. This ratio helps determine if the company can meet its short-term obligations. Evaluating the debt-to-equity ratio provides insight into the company's leverage and financial stability by comparing total liabilities to shareholders' equity. Additionally, the analysis of asset turnover ratios can indicate how efficiently the company utilizes its assets to generate sales. By examining these components, investors gain a comprehensive understanding of the company's financial health, risk level, and overall stability. For example, consider a company which reports a strong current ratio of 2.5, indicating that it has ample current assets to cover its short-term liabilities. This suggests good short-term liquidity. However, if you notice that long-term liabilities are increasing faster than its shareholders' equity, leading to a rising debt-to-equity ratio, this could be a red flag about its long-term financial stability. For example, if the company has been taking on significant long-term debt to fund expansion projects, it might signal increased financial risk despite a healthy current ratio. On the other hand, if the company's asset turnover ratio shows a decline over several quarters, it might imply that the company is not using its assets as effectively to generate revenue as it once did. This can be a sign that the company's assets are not being utilized efficiently, which could affect overall profitability. By analyzing these aspects of a company's balance sheet, you can gain a deeper understanding of its financial health, evaluate the risks associated with its capital structure, and make more informed investment decisions. A cash flow statement provides a detailed account of a company's cash inflows and outflows over a specific period. It is divided into three main sections: operating activities, investing activities, and financing activities. In analyzing a cash flow statement, you'll want to focus on the cash flows from operating activities, which show the cash generated or used by the company's core business operations. Positive cash flow from operations indicates that the company's core business is generating enough cash to sustain and grow its operations. For instance, if a company consistently reports strong cash flow from operating activities, it suggests a robust business model and effective management of its operating expenses. Next, examine cash flows from investing activities, which include transactions related to capital expenditures, acquisitions, and investments. Negative cash flow in this section is not necessarily a bad sign, as it might indicate that the company is investing in growth opportunities. For example, if company shows significant outflows from investing activities due to new factory openings, it could signal expansion and future revenue potential, although it may temporarily reduce cash reserves. Lastly, review cash flows from financing activities, which reflect how the company finances its operations through debt and equity. Significant cash inflows from issuing new debt or equity can indicate that the company is raising capital for growth or restructuring. Conversely, large outflows from repaying debt or buying back stock might reflect a company returning value to shareholders or reducing its leverage. Analyzing these sections helps assess the company's overall liquidity, investment strategy, and financial health. Mastering financial statement analysis is not just about understanding numbers. It's about gaining insights that can significantly impact your investment decisions. By thoroughly analyzing the income statement, balance sheet, and cash flow statement, you position yourself to make informed choices and avoid common pitfalls. Remember, success in investing comes from diligent analysis and a commitment to understanding the true value of the companies you're considering. There are no shortcuts, just hard work and dedication. And to be truly competent in your decisions, you need to just dive into the SEC website and start running your analyses. Compare your findings to other people who have made calls or written articles about their decisions. But don't let others' opinions guide you too closely. If you don't agree with their calls, use their insights as a reference point or to highlight aspects you might have missed, but always remain critical. If you can challenge and potentially disprove prevailing theories, you might uncover opportunities that others have overlooked. This is where significant gains can be made. Keep searching for promising companies. Stay diligent in your research and practice consistently. With time and effort, you'll become a master of financial analysis. Check out this video for a comparison of technical analysis and fundamental analysis. We weigh in with our take on how to use these practices to become a better investor.